I wasn't going to make a video about this, but I've been getting a lot of comments and DMs, and there's a lot of confusion, it seems, after the last FinTech Friday video where one of us actually sold a portion of their SoFi stock over how this event was handled by SoFi management. And that is, of course, the public offering that SoFi had this week, a public offering of 71.9 million shares for $1.5 billion. So I want to talk about this and express some deeper thoughts in its own video around SoFi raising money, how they went about it, and what they're going to allocate that money towards. Let's jump right into it. First of all, let's start with some details around this public offering. I'm sure most of you already know some of the details, but just to cover basic ground. So, this is on July 29th here, just earlier this week, a couple of days ago. SoFi announced that they priced their previously announced underwritten public offering of 71.9 million shares of common stock at $20.85 a share for total gross proceeds of $1.5 billion before deducting underwriting discounts and commissions. They've granted the underwriters a 30-day option to purchase an additional 10.7 million shares of its common stock at the public offering price. The offering is expected to close on July 31st. And in fact, this offering did close on Thursday, which is why we were talking about it on Friday. Of course, raising money, the main question that was there was around dilution. But even before we got to the dilution point, the main question was with regards to the transparency and the communication from management around this raise. First of all, I think a lot of it is not on management's fault. They actually kind of got blindsided, in my opinion, by being asked about this flat out. And that was not a great look, because what happened was a couple of hours before this raise, Anthony Noto was on CNBC and he was talking about this raise. And he was asked flat out whether they were looking to raise money. This was hours before the actual press release dropped around that public offering. And my theory here, which I shared on the Friday show, was that I think he was ambushed. I think somebody at CNBC had the news leaked to them. And I think they asked Anthony Noto point blank to see his reaction to this news. So this is the clip from Tuesday after the earnings was reported.
You'll want to raise some capital or kind of reset capital levels?
Listen, we're always looking at our balance sheet and making sure that we have our future plans well capitalized. We feel like our capital ratios are strong. They're obviously available for investors to take a look at, but they're well above our regulatory minimums. The capital market situation is one that we're always evaluating to keep our cost of capital low, but we feel like we have adequate capital on the balance sheet, but could be opportunistic from time to time if it can lower our cost of funding and help give us continued growth capital. But right now, our plans are adequately funded with our balance sheet, but we'll continue to evaluate opportunities.
So obviously that was something that rubbed a lot of retail off the wrong way. He basically said, hey, we're in a good spot right now. And if we can be opportunistic with us needing more money, then we will be, and we'll take advantage of that. But our capital ratios are fine. Our balance sheet is fine. Like, we don't really need more money. And then 3 hours later, they just announced this public offering where they're essentially raising another $1.5 billion. And so off the bat, I think a lot of people were pissed off at that, at just the level of communication. But I don't really blame him that much there, because I think that he was caught off guard. And you can tell by how I think he's stuttering, answering that question. He's trying to be very careful with his words there. And I know a lot of investors, it'll just rub them the wrong way and that they won't want to look past it. But if we do for a second, the main question here is with regards to potential dilution. Because if SoFi is essentially offering more shares into the market, they're cutting the existing pie into thinner and thinner slices. And for the rest of us who bought when there were fewer shares outstanding, now that there's more shares outstanding, we get diluted as a result. Now, in theory, that's the case, but in reality, it really depends on what they're going to do with this money that they raised. Because what they do with that money could very well increase the size of the pie. And so it won't really matter that you have the thinner slice, because the total size of the pie is now larger and you get way more from it as a result of them having done that event. And so really the question of dilution becomes a proxy to ask yourself, what will they do with that money that will offset my dilution as a shareholder of this stock? And the reality is that naturally it leads us into two prevailing possibilities as to what they're going to do with the money. At least this was a speculation for the retail investment community. And this is something that's currently debated. Just every day I see postings around what they're going to do with this. And I want to dive into each of these two prevailing possibilities. But first, let me cover a post that SoFi themselves put out when this registered offering successfully closed. So this post, as you can see, is by Investor Relations, and here they say they significantly strengthened its already strong position with greater strategic and financial flexibility, as discussed in connection with our Q2 2025 earnings release. SoFi's capital position was already adequate for our plans and more than adequate relative to our required capital ratios, which may beg the question, why raise more capital? That's exactly what everybody in the retail community is asking themselves right now, and they're addressing it in this post. Here is our perspective on what this additional capital means for SoFi and for our members. This opportunistic capital raise is a proactive step to provide flexibility to pay down expensive debt and to further strengthen SoFi's ability to consider opportunistic acquisitions, though none are currently contemplated. So basically here they're saying we can use it for an acquisition, but we don't have an acquisition in mind right now. Nothing is in their sights for them to potentially purchase. Number two, it gives SoFi an even stronger position for potentially greater growth, organic or inorganic. Inorganic means basically buying somebody else than we currently have planned and communicated over the immediate to long-term horizon. Number three, it increases the net cash position, and the additional net interest income from greater net cash would reduce interest expense, assuming a pay down of debt. As such, the combination is neutral to EPS. In essence, this additional capital will fuel continued innovation and growth as SoFi strives to help its members get its money right. And this post was essentially retweeted by Anthony Noto, saying that now that the deal is closed, we can answer questions that you may have. The ability to do so prior to closing is limited. He says that this post should provide clarity as to what's been asked. But for me, I still had a critique. And in fact, in the FinTech Friday show, I mentioned my critique was, well, the SoFi Investor Relations page, they answered with all of these bullet points around what they could potentially do with the money, but they didn't have a bullet point that said explicitly what they are going to do with the money. They said we could pay down debt. We could make an acquisition, although nothing is in our foresight right now. We could have a stronger net cash position. And yes, all of these things are necessary for the business to do. And I think a lot of these things will offset the dilution successfully through their company growth. But I want to know explicitly what they're going to do with that money. And maybe that is just me asking for a lot. And I should just trust in management to be able to efficiently allocate that capital, as they've definitely earned that right. But that was my main critique. Basically saying, if you're praising yourself for being openly transparent, at least tell us explicitly one of the things that you're absolutely going to do with that money, as opposed to saying these are all the potential options that we can do. Because a lot of the people in the SoFi community were already speculating as to many of those options. So let's start first of all with paying down debt. I think Tanner did a good job of explaining this, but I want to cover this post from Chris first and foremost. So Chris posted saying, I think simultaneously that number one, SoFi has excellent uses for this capital and it'll be accretive to the business. It's done from a position of strength. This has been the most incredible quarter. I trust that they have a lot of vectors available to put this capital to work. Basically, the entire management team owns way more stock than I do, and these shares aren't going to them. So it isn't like there's a misalignment of interest. Dilution hurts them more than it does me if this isn't for the long-term benefit of the company, which is a great point. Look, management's incentives are aligned with the investors' incentives. While everybody is diluted, they own way more shares and they're diluted way more than we are. The worst case scenario is they use this to decrease the $2.1 billion they have in warehouse facilities at 5.23%, saving them roughly $80 million in interest, while simultaneously giving them the ability to grow the balance sheet and turn that $1.5 billion into 20+% levered returns. So like $300 million in annual net income over the next several years. And finally, Chris wraps up this post saying that it's just frustrating that they're basically killing their momentum by having this news, which is bringing the stock down, especially because that earnings was so spectacular that the stock should have gone up as a result of it. But keep in mind that this isn't the first time, nor I think will it be the last time that SoFi is opportunistically raising money and issuing more shares. They've done this before, but in the past they did it with that capped call transaction, which would offset the dilution somewhat. Now, I think Tanner did a good job of explaining this on the FinTech Friday, so I'll play that clip so you can see the numbers that Tanner broke out and exactly how debt repayment would translate to a better earnings per share number, which would in turn lead to them beating their numbers by a larger amount relative to analyst expectations, and hopefully bring more share appreciation to the market so that the stock would go up as a result of the money that they just raised through this dilution, more than offsetting that dilution in the first place.
I just looked at how much they raised, how many shares that they actually added, the max amount, which I think is what's going to be what happens, which leads us to a new share count, 7% ownership dilution. If we talk about debt paydown, which is 0% execution, if they do business banking, if they acquire a crypto company, has execution risk. Debt paydown is not. You're going to the bank and you're saying, hey, I'm returning your money. How much left we actually have is about 39 million. If we just look at net income and shares outstanding, then yes, it is dilutive. But they've already said it's neutral. However, I don't believe them. I actually think it leads us to 32 cents based on a little bit of increased debt paydown. If they beat, like they do every single quarter, by roughly $32.8 million of net income, I actually think that brings us to 38 cents.
Why wouldn't they do another cap call transaction with us? If they believe that, okay, we're going to pay down the debt, it's going to be accretive to EPS, we're going to be able to completely demolish our numbers, it would make sense to do a cap call transaction and remove the possible downside of dilution in the first place, like they did with last time.
Yeah, stock's a little bit more expensive.
Okay, so hopefully between Chris's post and Tanner's explanation, you have a good idea of what exactly that would mean for investors if they were to go through this first option of paying down that debt and thereby not having to pay this very expensive interest anymore and having more money trickle down to the bottom line and being able to beat analysts' expectations with ease. Now, the second and probably the more sexy option, if we're being honest with ourselves, is an acquisition. One of the things that I really liked that Tanner said was if they pay down debt, it has zero execution risk. It's just math at the end of the day. However, an acquisition, while it is the more exciting, headline-inducing news, does have execution risk because they have to successfully integrate, they have to successfully accelerate, they have to have a vision for how this piece of the puzzle fits within that wider ecosystem and that wider roadmap. And so there is execution risk in an acquisition, but there is potentially way higher rewards in an acquisition relative to just paying down debt, which is like the easy answer, the safe answer to make. If we're going to speculate towards an acquisition, then I want to talk about that option as well. First and foremost, we're thinking of an acquisition in the crypto space. And the reason why is because management has been talking about the resurgence into crypto as a business. Anthony Noto even called it one of the big transformational technologies that we're going through right now on the macro. He said crypto and AI are basically the two biggest technologies out there right now. The idea here would be to have a company that's an established player in the crypto space that they could pick up, a company that has institutional knowledge with the correct infrastructure for an integration that would help accelerate their product roadmap further into that crypto space. Because look, one of the main value propositions of going through an acquisition route is speed to market. And so while they could hire all of the talent in-house and build everything up from the ground up themselves, if they want to be a leader in this space, it might make more sense to capitalize on the momentum and move quickly through an acquisition to basically have the established infrastructure ready to go. And the difficult part there would be to obviously integrate it and fit it with the vision, which is arguably easier to do than building that vision out from the ground up from scratch. The other point with regards to crypto-related acquisitions is it allows them to go deeper than just the brokerage side of the business, which they had before the bank charter. I mean, they talked on the earnings call about international remittance through the blockchain. They talked about stablecoins, staking, digitally native infrastructures offered through Galileo, crypto-backed lending. There's so many different opportunities that they can have in the crypto space that I know that they want to pursue, that they've said so much, and that an acquisition would eventually help them expand into way faster and probably in a smoother way because they're acquiring an established player already in the crypto space. And so this is a post here around who SoFi may acquire in the crypto space. Now, here is where it becomes pure speculation is, they can basically acquire any company out there in the crypto space. In fact, there's a full list here of crypto targets that they can potentially go after. Some of these are obviously more expensive than others. Some of these are more synergistic than others. So Bitco is infrastructure, BitPay, is a feature focused on crypto payment processing. So there's a lot of speculation here around crypto companies that SoFi could potentially make a move on to accelerate that acquisition further. Realistically speaking, though, I think it's going to be a combination of both. And even though management says that they have nothing in their sights right now for an acquisition, I think that they do, and that they don't want to announce something or they don't want to get the market's expectations up. I do think they're going to come out with an acquisition at some point in 2025. A crypto acquisition was on my wish list as early as, December 2024, even before the macro and the regulatory landscape was favorable for SoFi to be re-entering in crypto. But even though I say that, the debt paydown I think is obviously a no-brainer that they could do. It's a very smart thing because it really has zero execution risk. And the thing that got me the most confused is really why did they not do a capped call transaction whereby they limit dilution further if the stock price were to go up, similar to how they did before. I think it was 2024 or 2023, where basically they paid down some debt, but they also did a capped call transaction to offset that dilution. I'm not sure why they wouldn't do that same thing again, but there's probably a reason. So, of course, it came as a little bit of a surprise to a lot of the people watching to hear Roy's objections on the Friday show around the timing of this news. And to some degree, I agree with it. I mean, Chris also posted saying that it was something that killed the momentum. I also agree that, the communication wasn't the best from that CNBC interview, because when Anthony Noto answered that they're sufficiently capitalized, he knew behind the scenes that press release was going to drop after hours. And so that might have come off as disingenuous, but I've come to sort of cool on that aspect, saying that he was probably ambushed. But really, Roy's main objections was with regards to the timing. And that's what he was saying on the Friday show. He didn't really disagree with why they would use this money or the fact that this would be beneficial to the business, but he disagreed with the timing around it. Now, if this was to be some acquisition, the timing would make sense because they have their hands tied behind their back to some degree. They have some time restrictions that they need to act quickly to close that deal. And if that were the case, then we would get some news around an acquisition fairly soon. Because it would be contingent on their financing. But on the other hand, if there is in fact no acquisition planned, like that tweet said, them simply wanting to pay down debt and improve their EPS as a result, doing it now, I mean, you could argue it's opportunistic because the share price is elevated compared to recent levels. I mean, you have to keep in mind that the stock is up over 100% in the last 6 months or last 3 months alone. So management definitely wants to be able to take advantage of that higher stock price so as to dilute by a smaller amount. And Roy even had an objection to say, why not even do a bigger raise if that's the case? If you think that this stock price is too elevated, why not just go all out and even raise more money and dilute even further? And the reality is, I think management might be expecting the share price to continue to rise over the course of the year, in which case they could get a better bang for their buck down the line for future dilution. This is just my speculation, right? I don't doubt that there will be more dilution in the future. I just think that management is opportunistic around when they want to do it and how they want to do it. And this was just the latest episode in that. Because if the stock price is higher, they can dilute by the same amount, but they get way more money as a result of the share price being higher, right? Or another possibility is they simply just don't need that much money and they're only diluting by how much money they need. But even in the second circumstance, 1.5 billion is a lot of money, especially considering that they already had cash on hand. So it's going to be interesting to see what they're going to use this money for. And I'm sure that over the next several months, that's going to become more evident. We're going to get a concrete reason as to why they needed this money, as opposed to, a potential list of reasons. And finally, I think it's opportunistic for them to have done it right after earnings, because that earnings was fantastic and they probably knew the stock was going to pump right after earnings. And so while they don't necessarily know where the stock price is going to be 3 months from now, it could be detached from the fundamentals. I mean, SoFi was detached from the fundamentals for like 4 years. They did know that, hey, off the back of this amazing triple beat, that the stock is probably going to be elevated, and it was elevated relative to the last 3 months. It's been up double, right? So the way I see it is similar to how any investor would layer into a position through a DCA strategy over time, because nobody knows where the market is headed with a degree of certainty. And management probably thinks that, the stock is going to go up, but nobody, I think, can really pinpoint that in 3 months, this is going to be the exact stock price, and this is how much we need to dilute by, and let's do it then and not now, because the market has a mind of its own. So management is probably betting that the stock is going to go higher because they have their PSUs in 2026 that they want to hit. And just to wrap up, because I think it's been way too long, I'll share this post from Josh because I think it's a perfect summary to this video. Josh says, quote, keep in mind that the management team's PSU's first tranche is at $25 for an average of 60 days before June 2026, meaning that they can even hit it right now if they hold the stock price above that level for that time. So on the same day that they hit $25, Anthony Noto decides to risk his $53 million bonus by doing this offering. This tells me that he has strong conviction in whatever he plans on using the money for. In this case, Josh is speculating a crypto acquisition, but these are the targets that management has. And you can see here the targets are $53 million for $25 for Noto, going all the way to $100 million for the $45. And so essentially this is management reinvesting into something that could accelerate their growth even further to try to hit the highest tranche by June of 2026. Because if SoFi does hit $45, then that's like a double from where it's trading right now. And obviously management would get paid as a result of that. And if it doesn't, well, then management is getting diluted more than existing retail shareholders are getting diluted. And that's exactly what I want to see from the management team. I want to see them being aligned with shareholder interests. I mean, there was stumbles around how this was communicated, and you can argue around the timing of this, and we can debate around what they use this money for. But this is the news. This is what we know so far. And I think that management has not led us astray when we said, hey, trust management, that they are excellent allocators of capital and that they will know what to do with this money and where essentially to allocate it in the best form possible for the maximum ROI. Hope you enjoyed this video. Thank you so much for watching. Let me know your thoughts in the comments below. I'll see you in the next one.